On the face of it, the numbers given to us in the recent Chinese data round were just a touch disappointing. We saw retail sales and industrial production, fixed asset investment, one or two others, not quite hitting the heights that they have of late. Although the market was initially a little wary of this, it didn't really register. And later, we then got the credit numbers for the month, in which we saw a re-acceleration in loan growth and in total shadow finance growth, and everyone breathed a sigh of relief. Now all was well, the economy could continue to expand, and all the ramifications that had both at home and abroad would continue uninterrupted. Now the cynic would of course say is that we were very unlikely to get any major upheavals this side of the party conference in October. At least we won't get the reports of any major upheavals until after the party conference. But in fact, was there any such dichotomy? Was there a divergence between what the real side seemed to be telling us and what the monetary side seemed to be telling us? Well, monetary is the key word there, because if we move away from credit, the asset side of bank balance sheets, to money and the liability side, things were very much more in consonance and they were a deal less promising. Let me try to explain. So the recent release of the Chinese money and credit figures were widely welcomed. Headlines talked of strong, robust loan growth, and there was an immediate uptick in the price of financial assets and certain commodities, because of course everybody just wants China to borrow more money. If we look at the chart in front of us, we can see a somewhat complicated overlay of all this. But the key element I'd like you to focus on here is the green turquoise and then the light blue phase. And this shows the 12-month running addition in billions of yuan of loans, here highlighted, and then on top of that the extra shadow constituents, which give us the so-called TSF. If I can write this in with a mouse. There we go. So as you can see, there's been a marked acceleration here in the increment of new loans, and in fact the size of that increment is as much as 16%, and the number of loans that we've added in the past 12 months is 14 trillion, so well over $1 trillion a month. Add in a 30-odd% growth in the increment of the additional shadow entries, the entrusted loans, the bankers' acceptances, and so on and so forth. And the whole TSF has gone up 20% to just short of 20 trillion yuan. So how much longer can this go on? Can we continue to add and increase and accelerate? Because of course it tends to be the case that credit-driven expansions not only need a continuation, but they tend to need an acceleration, and certainly an arithmetical acceleration of new credit. Well, one clue as to why this might be becoming problematical is in the white columnar drawing here. And what this shows is a properly defined expanded M1 variation for China, i.e. demand deposits of corporates and households. And you can see here that into the great acceleration of last summer, off the bottom of the commodity and shale bust, taking us away from that low point, Chinese money growth on the other side of bank balance sheets, the spendable stuff that the non-financial sector holds at its banks, had a record increment. But what you can also see is that's beginning to fall away. So now we have an interesting conundrum. We have increased loan growth, increased shadow growth, but we have decreased receipt of deposits being created on the other side of the balance sheet. I think that there will be constraints emerging from this. Now, one of the reasons this may be a problem is that traditionally, and in fact often by mandate of the regulator, banks do not tend to lend out all their deposits. The reason is a simple one. It's for liquidity purposes. All transaction deposits and demand deposits by definition can be taken out straight away. Even time and savings deposits can usually be removed at fairly short notice for the payment of a penalty. But loans, of course, are usually much more difficult to recover. They're entrained in the bricks and mortar of your house, or they're locked into a productive process which will take some time to come to fruition. So banks tend to lend out very much less than 100% of their deposits, unless they're in some crazy situation where we know problems will arise. And in fact, in China, there have been hard ceilings on this, which tended to be around 75%. Now the little graph on the top here shows us this loan deposit ratio, and we can see for WAN loans, and we can see that having bumped somewhere in the high 60s, after 2011 this ratio started to climb, climbing up towards, if not a danger zone, then certainly the levels at which the authorities became concerned. There's a break in the series because here miraculously they suddenly discovered a whole bunch of new deposits which had supposedly been erroneously categorized, and so that reduced the ratio conveniently. But you can also see here that notwithstanding that, we're on the way back up again. So we're starting to get to high levels, certainly very high compared with the experience of the past 10 or 12 years. What's even worse is if we look at the marginal loan to deposit ratio. Now in this case we've taken the 12-month growth in loans and the 12-month growth in M2 deposits. And you can see here that that has tended to bump either side of 75%, but that in this recent move it is shot up to 100. So in the last year, effectively, we have granted 14 trillion yuan worth of loans and taken in 14 trillion yuan worth of deposits. This is not a situation which is particularly comfortable. In addition to which, you can see in the block in the background we have the shadow component, and we have measured this against deposits. Now of course the shadow by definition includes non-bank activity, but still, look at what's happened here. Here's the great reflation after the Lehman crash, and here is where we are today. We're already above that level, and look at the acceleration. Look how much extra shadow credit we are granting compared with the deposits that we're creating. This is starting to get to levels where alarm bells must be ringing. Now going back to our first slide for a moment, let's put some numbers on this. So the increment in loan growth over 12 months here has risen by 16% since last summer, since the peak. The increment in total social finance added has increased by 20%, 20 trillion yuan in fact. M1 creation has plunged 30%, and not shown on this graph, but adding back those times and savings deposits and getting to M2, they've fallen by 13%. So total social finance added in the past 12 months has gone up by a fifth. The deposits, which theoretically fund that in the same period, have fallen by an eighth. There's a squeeze coming in this system somewhere. Now let's look at this in a slightly different version. What we've done here is we have taken the loans and we have regressed them against M2 growth. We've used logs in both cases because we're talking about growth exponential processes. And what we've done here is we've actually divided it into two sections either side of the Lehman collapse and the subsequent emergency credit expansion in China, because the boost to loans then was so high and so extraordinary that it throws out the whole series. But in fact, the behavior of loans either side of that peculiar instance is very much the same. For the 8 years before, loans grew at a compound rate of about 15%, and the 8 years since, they've done exactly the same thing. So there's not been a great change in loan behavior, but let's look at what's happening in terms of the ratio to deposits. And again, you can see that we were pretty comfortable in here, creating lots of deposits for the loans. The loan to deposit ratio was not under stress. Regulators could have been reasonably relaxed. Prudential requirements were easily being met. But now look, since the end of 2014, up we go. Up, back to the norms, past the post-crash high, and if we ignore this early data, which is somewhat suspect, way back here in 1999, we're potentially at the most extreme levels we've been. Again, signs that potentially there are stresses building in the Chinese banking system. Now let's stick a moment with the liability side of bank balance sheets, the monetary aggregates. M1 is proper money, it's spendable demand accounts, corporates and households. M2 adds in time and savings deposits for those two institutional groupings, plus a certain component of other financial institutions. Now you can see what we've done here is we have taken the log trend over the 15 years to 2015, which is just under 18% for M2 and just over 16% for M1, and we have then compared that to the 12-month rolling rate of growth. So if M2 grows in any 12-month period at 20%, this blue line will be above the norm, and if it grows less, it will be below the norm. So what you can see here is we had the great expansion, the great emergency injection. We then normalized. We dropped to about a standard deviation or so below the trend and brought us back into a better balance. We then in fact dropped away somewhat in terms of M1 and M2. When the Chinese central bank started to inject extra monies through all its special programs over the past 2 years in order to compensate for the loss of foreign exchange reserves, which help provide the monetary base which underpins all this, we got a tremendous acceleration in M1, but it was a pretty lackluster follow through into M2. In other words, there were lots of transaction accounts being created, lots of money, which is of course the most inflationary form we can have, and we saw a pickup in house prices, we saw a pickup in commodity prices, the stock market began to perform a bit better. But the last year has seen a deceleration again, and that deceleration has taken M2 off the levels that we haven't seen in the modern era. Now in this graph we've used the same trends, but instead of comparing the current 12-month growth rate to the trend, we are looking at the levels and the divergences from that trend. And you can see again for M1, here's a plus or minus 1% pattern around a pretty steady rate of growth. Here's the extraordinary reflation after the crisis. Here's the fall away back to normal levels, and okay, still one standard deviation below, nothing too exceptional into the end of 2014. The loss of foreign exchange deposits and perhaps the bleed of money abroad depressed M1. The Chinese central bank countered. That was the acceleration we saw in the previous chart. But again, now look, in the last year, it's slipping away. So we're below trend, we're diverging from that trend. Monetary growth is not proceeding smoothly. And if you remember, as bad as M1 was looking, M2 was worse. So here's the difference. And this time, these are the extra deposits and savings accounts that add up to M2. And again, you can see, let's ignore the early years here, but you've got a pretty good plus or minus 1 through the band in here. And then somewhere around 2 years ago, we suddenly get some sort of dislocation. Nobody particularly now wants to hold a time or savings deposit, or nobody has the means to build one up, whichever is the answer. And look at the plunge. Look how far away we are from that previous trend line. 4 standard deviations from a trend plotted from 2000 to 2015. I would suggest that this is at some point is going to constrain loan growth. And unless everything is going to go into the shadow sector, which the authorities are none too happy about, overall credit creation has to slow in China. How much will that matter? Well, pretty much. China is an economy which is effectively a rolling series of intermittent bubbles and busts. We go from a stock exchange boom to a real estate boom to a commodity boom. Occasionally we get a bond boom in the middle, and then we go back around again. The authorities flood the system with money. It goes in the wrong places, it causes excesses, it excites over speculative activity. They clamp down one way or another, whether it's through the monetary system or with rules and regulations, so-called macro-prudential stable door bolting, and we go off again. Here we have a thing actually going on in the real economy. So here we have the PMI under its various sponsors against the change in M1. We've taken the arithmetic PMI change against the percentage change in M1. And you can see pretty good correlation, up and down together, big boost up and down together around the crisis, and then the subsequent slowdown. This, of course, is when the commodity echo bubble, echo bounce faded out. Sideways oscillations. Here's the expansion we talked about going into the middle of last year, and here's the subsequent deceleration, and you can see that having got to the best levels since the reflation, the PMI now is beginning to roll over. It's still in positive territory but if the money supply continues to decelerate, this too is going to head downwards with all the consequences you can expect on the assets that we price off this. How does this come about? Well, the PMI, of course, isn't a quantitative measure. It's a qualitative measure of are things good or better. But if you put extra money in the system and that extra money is flowing, the money goes into corporate cash registers. Once it's in a corporate cash register, the guy handed the survey form thinks, whoa, we've had a lot of sales this month, cha-ching, I'm going to say things are better. So there is a correlation, and this correlation holds across several economies. We can do pretty much the same thing for the ISM in the States, the IFO in Germany, and others as well. So this is a good mix of hard and so-called soft data. Now, of course, the real action in the recent boom has been in the real estate market. And once again, if we look at that over a period of 10 years or so, we can see how important, how intrinsically linked these two things are. We have plotted here change in M1 against the change in new real estate turnover, in sales if you like, and it doesn't need much illustration to show that they move in the same direction. It's not strictly a correlation, but they grow together, they slow down together, accelerate, decelerate, accelerate, decelerate, and so on and so forth. And in the last period, since the middle of last year, the monetary deceleration is showing up in the real estate market. Now, there may be an element of cause and effect working the other way here, because we know there have been all sorts of moves to regulate real estate, to make it more difficult to speculate, to make it more difficult to take out second mortgages and so on and so forth. And perhaps the lack of credit activity there means that deposits aren't being created on the other side of the balance sheet. But nonetheless, these two move together. And here are the prices of real estate in won per square meter. And again, you can see they all move in pretty much the same direction, and you can also see that the current direction is downwards. And if real estate slows, if construction, if fixed asset investment, if the PMI slows, what do we think is going to happen to commodities? And in addition, what's going to happen to all those speculators who are running in commodities because they think China is booming? Well, here's the steel price, perhaps the archetypal one. And don't forget the rebar contract is one of the most traded contracts in the world. And again, we've plotted it here for 15, 16 years against money supply. And funnily enough, look, the booms and the busts, the peaks and the troughs are all pretty much in the same place. And here's the money. This graph is plotted with a 6-month lag in the steel price. The peaks pretty much coincided. We got an initial deceleration in the steel price. We've got this little echo bounce here. The implication is that we're headed in this direction. Now, this will still, for a while, be a positive steel price, just a much less aggressively climbing one, but nonetheless, there comes a point where that too will turn down. And as we say, with the intense speculative positioning in it, that might be more violent than we think. So to recapitulate the argument, the current increase in loan and shadow growth is outstripping the bank's abilities to attract and retain deposits. The deposit slowdown is showing immediately in deceleration in money supply growth. Money supply growth correlates, coincides, co-moves very clearly with all sorts of levels of activity, whether it's on the real side of the economy or more in the financial speculative area. If the current trends continue, China will slow down. There will be a disappointment in those markets which have been based off it continuing to boom, not least industrial commodities. So ladies and gentlemen, I hope you found that enjoyable, informative. I hope it gave you some food for thought. I hope you would agree it's a slightly different perspective from the one that you normally receive elsewhere. Now, of course, if you'd like to receive more of this on a regular basis, you can contact me at info@cantilon.consulting.ch, as you see on this slide. I'm happy to undertake general macro research, help you with specific projects, provide some content for perhaps your regular reporting season, and help you with client presentations and occasions. Been doing this a long while. I enjoy doing it. I try to bring something different to it. I think I can do something for you, so please contact me when you have the opportunity. Thank you.